Is it earnings or is it the Fed? Which one is more important right now?
Well, it's got to be both. I think that earnings will be first. We have to digest the impact of some very key earnings results. I think the really interesting thing right now is that the Federal Reserve, the ECB this week, in terms of setting out what they will likely do in coming months, can have a very large impact on valuation. We've seen massive easing in financial markets. 100 basis point drop in Italian bond yields, 200 basis point drop in Brazilian bond yields. Central banks can have a large effect on valuation. They can probably only have a marginal positive impact on economic activity. So the question is, what happens after this quarter's earnings? We don't think we'll have a problem here. We think earnings estimates, as usual, have been lowballed and they'll beat. But when you get further out and all that impact of easing is in the marketplace, what then? We have 11% expected EPS growth for 2020 in consensus estimates.
So let's talk about that easing, because the markets right now are predicting somewhere between a 25 basis point and 50 basis point cut from the Fed this month.
Right.
Which is it going to be, or if anything at all?
So just guessing, I'll say 25 over 50. I think that the Fed is really debating this. You saw on CNBC Friday, one Fed president, a voter, have a point of view. And you've had these comments about what are the tactics if we really wanted to make certain that we preserve the expansion, that we boost activity to have a higher demand rate, a higher inflation rate right now. Why not ease a lot right away? And then perhaps we'll actually preserve the power to ease more later by not having to, right? The problem with all of this is that we've had 2 decades of reactive monetary policy to any sign of weakness, and you've still had 2 fundamental bubbles and busts, and then you've had more disinflation. So it's a very, very difficult place for the Federal Reserve to be. It's a hard job right now.
So we've had 2 decades also of markets, traders, investors reacting to this type of monetary policy and intervention by the Fed.
Yes.
How is it reacting right now, given those historical precedents, and what will the markets do if they get what they want or don't get what they want?
So my speculation is that we've become quite sensitive, more sensitive over time, and willing to jump in advance and speculate that monetary policy will be there to ease more. So you tend to have more front-loaded effects. So what we've seen, again, especially in fixed income markets where there's been, a very big rally, look, if we don't do 50 basis points at the end of July, we can probably expect some slight setback at least, right? Some rise in bond yields, some potential strengthening in the dollar if it's 25. And so you can imagine this. We have a currently strong economy. I think we have some very legitimate signs of future deceleration and worry. If the Fed is making a mistake now, it's making a smaller mistake than last year when we had tightened, 4 times plus QT for a whole year, quantitative tightening. But this environment right now, we could still end up with some disappointment, even with an easing right now.